From the morning reading, support holds and breadth strengthens. The FOMC begins Tuesday, the jobs report on Friday. 6 of 10 sectors moved higher on Monday. XLU, XLRE, and XLP were the strongest sectors, while XLE was the weakest sector. All futures dropped $1.90 to close at 46.76, its lowest close since September 27th. Breadth strengthened compared to the prior session, as the New York Stock Exchange had 1544 to 1487, and decliners led 1415 to 1345 on the NASDAQ. On the S&P 500 snapshot, stocks go nowhere. Stocks went nowhere on Monday's session. All three of the widely tracked U.S. indices finished in the shallow red. The preferred benchmark S&P 500 opened higher, bounced off Friday's closing price to its modest 0.32% intraday high in the late morning. It then sold off steadily to that same Friday close trampoline, made a tiny bounce, and then closed flat with its fifth consecutive loss, albeit a minuscule minus 0.01%. This is the first 5-day sell-off since mid-June. The 10-year closed the session at 1.84%, down 2 basis points from the previous close. Momentum underlying the broader market has switched. The Mcclellan Summation Index, a long-term indicator of the momentum in advancing versus declining securities on the New York Stock Exchange, has dropped below zero for the first time since February. Stocks tend to underperform when the summation index is below zero, but a mitigating factor is that the momentum was so persistent with 170 days above zero. Option traders are getting a little worried. Despite a small loss in the S&P 500 over the past week, the VIX fear gauge has jumped more than 30%. That's one of the largest increases in uncertainty for a 2% or smaller loss in the S&P. Whatever the reason for the increase in hedging activity, precedents have led to a slightly bullish bias for stocks over the next week. Small down days. The S&P 500 has declined 7 out of the past 8 days, but for a total loss of less than 1%. That hasn't happened in more than 30 years and only a total of 5 times since 1928. For what it's worth, stocks rose the next day 4 times, declined the next month 4 times, but then showed a positive return again 3 months later 4 times. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:04 a.m. Mountain Time, and I'm recording this in preparation for the market day of November the 1st, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go to the morning report. At the time of this cut, all 4 of the U.S. broad-based indices were positive. The S&P futures up just above scratch. The Russell futures were the strongest and up about 0.25%. NASDAQ and Dow futures are also up just above scratch. Crude oil down about 1/3%. Euro up about 0.5%. Bonds down a little below scratch, and gold up about 1.2%. And overseas action, everybody was open. China was up about 0.75%. Hong Kong up nearly 1%. Japan up just above scratch. Germany down just below scratch. And United Kingdom up just above scratch. In terms of macroeconomic reports for today, with respect to the United States, of note will be the ISM manufacturing PMI. And that looks to be about it of major reports. No, there are a host of minor reports which in themselves would probably not move the market. In terms of current volatility conditions, short-term VIX up over 20. First time we've seen that in quite some time, 20.19. Skew also in the cautionary stage, up over 125. And IV percentiles have been climbing. So compared to the 52-week range, the S&P is at a 45, the Russell at 33, the NASDAQ at 36, and the Dow at 41. No standard deviation moves were put in yesterday on a close-to-close basis on any of the U.S. broad-based indices. We continue to be very, very low, and the number of standard deviation moves in the last 2 trading weeks, you see in the S&P, there's been no days. And indeed, one of the morning authors mentioned that the S&P's declined 7 of the past 8 days, but yet the total loss of all that activity is less than 1%. Pretty remarkable. And indeed, that had not happened in more than 30 years. Let's go ahead and go to the charts. Now, obviously, part of this is probably related to the election and waiting to see what the outcome of particularly the House and Senate races at this point. Let's go ahead and zoom in on the most recent activity for the Snp Futures, and you can see this activity where, you know, we've largely just chattering back and forth, lots of wicks, and frankly wicks on both sides, up and down. Relatively small bodies on most of this activity. And really, if you think about it, you know, so our current price, let's say it's 21.23. Well, let's go back, you know, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, you know, some 15 sessions ago, we were at 21.25 and change. You know, it's just it's been a lot of go nowhere lately, and we talk about that endlessly as we look at the charts, looking for some indication that we're going to have a breakout from this action, and frankly, it doesn't show anything yet. The Dow futures, if it could be more sideways, it is. I mean, look at those. It's just amazing. One day after another, and going for now, you know, it would seem about 3 weeks here in which we've really done nothing. And while the prior range was a little wider, I mean, ever since 9.9, we basically are in the same place. I mean, you literally cross through today's price, current price on 9.9, and since 9.9, we've just been basically rotating around that horizontal level. NASDAQ really has degraded. This was the most bullish, and you know, at this point it's just barely above the cloud, and frankly price action is probably below most of the key moving average lines and sandwiched between those moving average lines and the cloud. And if it hadn't been so bullish back in the summer, we would probably be inside the cloud. So it's one of those things where even the NASDAQ has now deteriorated. The Russell, of course, deteriorated earlier and is now broken down below the cloud. We've had a little bit of a bounce in the last couple days to come up off this. The question now remains, does it recover, or does it start to continue these lower highs and lower lows? So you've got 2 of the indices, the biggest and most important perhaps, in the S&P and the Dow, and totally sideways motion. You got the NASDAQ that's deteriorated into a sideways motion and lost much of its bullish bias, and you have the Russell, which has deteriorated below the cloud and is in a short-term bear trend. So not a really good picture there for the bulls. Let's take a look at the other markets. Crude oil has broken down. You heard one of the morning authors mention about the percent drop yesterday, and you look at this. I mean, so we were looking at this prior resistance turn support, and it did hold for a couple days, but a clear breakdown, then confirmation, and that confirmation came hard and fast following that breakdown. So a lot of people who are holding on had their stops run, exited their positions, perhaps even flipped their position short, and you've got a big run to the downside now. We talked yesterday that this might run down here to about the 46 area, and doggone, it's just about done that in just one day. In terms of gold, are we starting to see any kind of movement there? Is there any kind of fear starting to come into the market that might show that the equities are starting to perhaps break down? Well, we've had a little bit of a bullish bias of late and a little bit of a move in the last 3 days, starting to cross through some moving average lines. The question is it about a fear premium, or is it just simply the dollar? Well, right now, I would say this is reaction to the dollar, not so much people running for cover, as the dollar has been in something of a retracement. We'll wait and see how far this retracement goes, but that would seem to be a correlation with the dollar at this point. And then let's take a look at bonds, the other kind of place that people run for safe haven. They don't seem to be indicating any kind of move towards safety at all. And indeed, we've got a short to intermediate term trend in the long bond towards an unwind. And then finally, volatility. Volatility has been ticking up. You heard me mention earlier about short-term VIX up over 20, and the regular VIX, is hovering around, 17 and change at this point. If we get up above 18, we basically, at that point, leave the general area where we think of this as a bullish zone of volatility. We kind of think of 12 to 18 as the realm of volatility in normal bull markets. And we sometimes separate that into two parts, the 12 to 15 and the 15 to 18. We clearly have gone from that low part in the 12 handle. Now we're up into the upper part of the 17, but we're still within the realm of normal bull market. So volatility has been ticking up, and I would suggest to you this is indeed very much related to the upcoming election. We have been talking about this, how when you now go less than a week, here at 8 days out, the volatility ticks up from a 29 to a 53. This is all about the election here and the uncertainty around that. And there are some people who are hedging against outcomes of the election, or perhaps just take an opportunity to make some money off of the volatility that's expected to occur after the election. So there's some plays going on right there, and some traders loading up for some positions, and that's giving us this increase in volatility without the parallel increase in actual price action in the S&P. I mean, we've done nothing to warrant this 30% increase in volatility in recent days, other than, you could say that we are certainly near a key support area. We've talked about this in our own hedge risk level opinion. So certainly that's true, but guess what? That's been true for a month. So why the 30% increase in volatility now? It's the anticipation of the election, would be my opinion. So that's enough on the charts. Let's go ahead and go to the daily report. And we continue to see an awful lot of weakness here. Market term phase opinion is in terms that definition, market phase 5, the break of diagonal support, though we continue to give credit to the fact that the break of horizontal support has not happened, other than with the Russell. The Russell did break its diagonal and horizontal support, but the big one is the S&P 500, and it has held repeatedly the horizontal support. So that key support being held by the bulls is of some significance. So the three market timing signals, no real change from yesterday. The first one from IBD, uptrend under pressure in cautionary warning area. The GMI index did improve a tick to a 2 out of 6. A sell signal, though, has been in place since 10-12. And then stock charts, decision point scoreboard, the third mechanical signal, remains decidedly neutral to bearish across the various time frames. And even here, where you have two opposing signals, I'd call that, in effect, neutral. So the consensus of all these three market timing signals and their mechanical systems is a neutral to slightly bearish kind of model. And we might say more than slightly bearish, given some of the indicators' other settings. Position sizing opinions currently at 50% and 75% for both the position sizing of the portfolio investor, as well as the model for the active trader based on volatility. Intermediate term market posture is quite strong bear. The S&P is now dropped to a 29. If this drops below a 20, we'll probably see the hedge risk level drop to a 2+. So that is, not good place. So we continue to recognize that we are being supported at that key support level, but these numbers kind of here would lead us to believe that that support will fail at some point. It's just really probably a matter of when. Now, if new information comes into the market that gives energy and momentum to the bulls, you may see all of this reset back into the black and a bullish rally occur. That's what happens in bull markets. And if we continue to think that we're in a bull market, in the big picture, these kinds of things can kind of quickly go away. But we certainly have raised the level of concern with all these different indicators, all generally pointing to the bearish side. Others, the Dow, the NASDAQ, also strong bear, and the Russell just about as low as it can get at a 6.5, a severely strong bear pattern. This is all reinforced with the weak bear sentiment line, so the expectation is that bearish moves would be the longer and more pronounced moves. We mentioned a moment ago, hedge warning status still remains level 2. This is in some danger of going to 2+. And then also, in terms of the strategy opinions, no change from yesterday. VIX is still somewhat acceptable in that it's still under 18 to initiate new positions for novice traders, but we also note that the hedge risk level is at level 2, so that would call for some caution. Novice traders probably want to be really careful about initiating new positions right now. More aggressive traders, this is an additional premium and so forth. There's opportunities there, but they are, of course, more skilled at making the adjustments and being able to have the capital to make those moves. Covered calls and put sellings with the hedge risk level 2, not acceptable to initiate new positions for novice traders. Aggressive traders should use very defensive structures, such as a 2-to-1 ratio of in the money versus out of the money strikes, and a 2-to-1 ratio of low beta versus high beta. Even better, consider legging in to those positions through the selling of out of the money puts. Also keep that position size in the scale that you're willing to own, and you might even want to consider reduced position size at this time. In terms of the specific warning areas, we continue to see a sea of red. Market in decline, sharp increase warning. The ratio warning recently fired a few sessions ago. The daily squeeze has fired. I had to kind of blow it up. It's just barely fired with yesterday's session. But the process of a daily squeeze firing has begun with the VIX futures. And you could see with that rise in volatility of some 30%, that started to expand that price action on the VIX out of its squeeze. The distribution day count remains 7 for the NASDAQ and the S&P, so that's elevated. VIX phase has been increasing. Skew is elevated and running about a 9% probability of a 2 standard deviation move right now for the next 30 days. Current day expected move is up over 40. Indeed, it's up over 50. That takes us just past the election, so there's expected to be some volatility in the short-term time frame. In terms of the trend-based, all 3 of these are in warning status, and this New York Stock Exchange new high, new low. Once again, this is like 4 or 5 sessions in a row where we've been in warning status, up over 300 on the new low side. Yesterday came in at minus 454. The intermarket risk aversion indicators, all 5, continue to be risk off. In terms of sentiment, this is probably the place where there is some modest kind of neutral stocks, both short and intermediate term, very, very balanced and not particularly heavy, though the fear and greed index has been dipping down into the fear category, and indeed at 25 would go to extreme fear. So we have seen deterioration on the fear and greed index and the measure of sentiment there, so keep that in mind. A week ago this was 55, and we've been slowly but surely dipping down since. In terms of sector-specific information, it was a day for the defensive sectors, our stubs, consumer staples, our telecom, and of course there's only 5 companies here, so kind of a mixed signal there. But utilities were the hero of the day, up almost 2%, and every single utility in the sector was in the green for the day. And you have real estate, and then of course you have the long bond. It was very much a rotation to risk off and interest rate sensitive kinds of holdings yesterday, whereas the higher beta, more risk averse, or the more risky, I should say, more risky holdings were the places where you continue to see some deterioration. Energy and healthcare, and we talked about this yesterday, that some folks might think of healthcare and energy as being 2 sectors that would be losers in a Hillary administration. And, they've shown a lot of weakness of late. So, perhaps some front running the expectations of those elections and starting to price that in. So we'll start to see if this is just a dip or something bigger. We've seen the dollar move, and dollar also has an impact on energy for a very real correlation. So we'll be careful not to make too much of these rotations until we can start to see something more protracted. But we'll start to see, and we've seen this volatility priced into the market. Well, part of that is going to be these resets as the winners and losers of the election. So when it comes to specific sectors, industry groups, and companies, and how they would be expected to fare under a new administration, will start to be priced in to the marketplace. That's the heart of technical analysis. So that's probably enough for today. We've gone about 20 minutes. So let's go ahead and wind this up. As I roll through these slides, if you see something of interest, just hit the pause button, and you can take your time, go to the hyperlink, get the additional information that's being referred to on that particular slide. And I'm going to go ahead and roll over to the disclaimers. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the full disclosure down here can be found with this hyperlink. In the meantime, I expect that we'll be back here tomorrow for the next session of the Falcon Global Market Preview. Manage that risk, and everything else should fall into place. And good trading. Be sure to go out there and learn something today as well.